The Federal Reserve is the U.S. central bank that oversees and regulates the banking system in terms with its use of monetary policy. It's made up of the Board of Governors, which resides in Washington, D.C., which consists of 7 people appointed by the president to serve 14-year terms, and 5 rotating members from the 12 regional banks, one of which is always the head of the Federal Reserve in New York. These 7 people plus the 5 people from the regional offices create the Open Market Committee, which is in charge of regulating the Fed. The Fed has 4 main responsibilities in our economy: to maintain the stability of the banking system, provide financial services, supervise and regulate the banks, and conduct monetary policy. Now, in terms of conducting monetary policy, the Fed has 3 main tools that they use. They have the reserve ratio, which is the percentage of deposits that banks must keep on hand. This affects the amount of money that banks can loan out and affects the likelihood of a bank going into a bank run, because a higher reserve rate requires the banks to hold more money, and thus the bank can fulfill more deposits at any given time. The Fed is also in charge of setting the discount rate, which is the rate that banks must pay on loans that they receive from the Fed. As I said earlier, one of the 4 main roles of the bank is to provide banking services to other banks. The Fed is commonly referred to as the banker's bank because it's where Citi or Bank of America goes when they need loans, when they need to store money, when they need to write a check. It's taken out of an account at the Fed. The Fed's rate, the discount rate, also determines the rates that banks will charge each other to lend money. Traditionally, that is lower than the Fed's rate because the Fed wants to encourage banks to go to each other before coming to them. But it also affects the rates that banks will charge consumers, you and me, in order to get out loans, whether we be buying a house, a car, buying stocks on margin, anything like that. All those rates and the amount of money that we are forced to pay is determined by the Fed. The third thing that the Fed does is open market operations. This is simply the buying and selling of government bonds or U.S. Treasury bonds, effectively government debt, with the member banks. This allows them to lock up money from their member banks or add more money, which provides them the ability to control the money supply. And that's really what it's all about. The Fed uses these 3 tools to control the money supply, which is its biggest way to emphasize and create stability in our economy. Now, without banks, give me a second here. Now, without banks, the money supply would simply equal how much money there was in the economy, the amount of money. So, the money supply would be controlled then by the Treasury / Bureau of Printing and Engraving, because they would basically say, oh, we're going to increase the money supply by printing out additional dollar bills, correct? Well, while that would be the case for if we didn't have banks, the fact that we have banks who provide loans, control deposits allows you to increase the money supply without actually printing additional money. That's not how you park, bud. Okay, so if you all remember the T accounts from the banking video, we're going to head back over there just to get a little peek at how loans with banks increases the money supply without increasing the quantity of money.
Let's say there was an old man who kept $1,000 under his bed. Well, one day he decided that it'd be a much smarter idea, rather than leaving the money under his bed, to put the money in a bank. So he got up, put all his money in the bank. Let's take a quick look at the T-chart for this bank currently. So let's say theoretically this bank had a reserve ratio of 10%. Now, this old man just deposited $1,000, so the bank is going to now have $1,000 in its checkable deposit account. Because the reserve ratio is 10%, that means the bank's required reserves is going to now be $100, and its excess reserves will be $900, everything not in the required reserves. Now, in the case of this example, all of our other categories are going to be the exact same. So, now that this man has deposited his money, let's look at this bank loaning out the money. So, let's say this bank uses all of its excess reserves and makes a $900 loan out into the community. Right? Well, this community member is now going to spend the money or do whatever, but that money is going to find its way back into a bank. Let's pretend it's the same bank for this example. The bank's checkable deposits are going to increase to both the original deposit and the new deposit, even though no new money was created. We still have the $900 out in loans, but we now have even more money in our required reserves, again because of the reserve ratio, and more money in excess reserves, despite the fact that no new money was created. This is an increase in the money supply. Now, I'd like to point out that in this example, we're not going all the way through it, but what would happen is that you'd take the $810 from excess reserves, make a loan out of it. The loan would make it back to the checkable deposit. This would happen over and over again until the bank's reserve ratio kept all its money in the required reserves, and they had no excess money to loan out, because the bank will try to loan out any money possible, because that's how it makes its money. So, you might recall from an earlier unit the concept of the spending multiplier. This is very similar, where every $1 put into the economy equates to more than $1 increase in, back then it was in GDP, but now we're talking about in total money supply. Well, you're completely right about that. It's called the money multiplier, and we refer to it as 1 over the reserve ratio. So for this example, it's 10 is the money multiplier. Now, the money multiplier is used in two different ways, and you have to consider how money is being added to the bank when you look at the money multiplier. If money is being added directly into the asset side, let's say the Fed bought $1,000 worth of loans from this bank, or securities from this bank, treasury bonds, you just multiplied $1,000 by the money multiplier, add that to the excess reserves, and then go through with all the loans, right? But if it's $1,000 being added into the liabilities side, you actually have to take 1 minus the money multiplier when you multiply it by that deposit, because you have to consider the fact that part of that initial deposit has to go straight into required reserves, whereas when you put money straight into the asset side, there's no increase in the required reserves.
So how exactly does the Fed control the money supply using the 3 tools we talked about earlier? I touched on it a little bit, but we're going to go a little bit more in depth.
So we're going to do a little mock-up here. You see we have our 2 commercial banks, the one Federal Reserve Bank, and then the 2 money bags underneath each of these banks represents the amount of excess reserves the bank has. So the larger the bags, the bigger the excess reserve, meaning the more loans the banks can give out, meaning the greater the money supply. The smaller the bags, the smaller the excess reserve, the smaller the amount of loans, and the smaller the money supply. So, let's say in this experiment that the reserve ratio was 10%. Well, if the Fed were to raise that to 20%, the required reserves would increase, meaning the excess reserves would decrease, the banks could give out less money, and the money supply would decrease. Let's do a little reset here, and let's look at the second part, the discount rate. the discount rate is 10%, banks are going to want to have are going to feel more comfortable lending out money because they're going to know that it's easier for them to get money from the Fed should they run over their required reserves number. However, if the discount rate goes up, their excess reserves are going to increase as well because they're not going to want to take the risk of running over their deposits. So the money supply is going to go down due to the fact that they're not going to loan out as much money. You also have, in theory, bonds. And there are two different things that they do with their open market operations. So let's say this bank here, bank number 2, has a bond. Well, the Federal Reserve might buy that bond, which will give that bank money that will go into their excess reserves, allowing them to give out more loans. Then that bank might go and sell that bond to another bank, therefore decreasing the amount of excess reserves they have and therefore reducing the loans. So you can see whether they're buying or selling, they're affecting the supply of money. When they sell it, they're reducing the supply of money, locking it up in these bonds. When they're buying it, they're freeing up that money, allowing banks to make more loans.
And that's pretty much all you need to know about the Fed. There's a lot of interesting history and with different chair people, how they've looked at it, and it's very interesting, but it's nothing that we're going to go into in the context of this video. So, hope you enjoyed it, hope you learned something about the Fed. It's not usually a big part of the AP test, but it's helpful to know, especially not necessarily the makeup of the Fed, but what exactly the Fed does and how it changes banks is probably the most important thing to know. So for right now, I'm your host, Duncan, driving away into AP Economics.